Hello, I'm Tripp Babbitt of the Stats Detectives. In our third episode, Dr. Frony Ward and I take a statistical view of the Dow Jones Industrial Average.
What are we discussing today, Frony?
Oh, Tripp, we're discussing my investigations into the Dow Jones Industrial Average. I periodically go play around with it a little bit, and if the news gets exciting, I say, well, it's time to go look again. So
okay.
One of the things that I have done now that I've been playing around with the Dow and looking at it and seeing what it's doing day to day, as I've gone back and looked at what is this creature that we're looking at called the Dow Jones Industrial Average. So I went back and found out it's made up of 30 stocks. The 30 stocks have been in there anywhere from General Electric in 1907 to Apple added in 2015. So they didn't all come in at the same time, and there's been adjustments made in those 30 stocks. There's a huge amount of effort by the Wall Street Journal to make sure that the components of the Dow will reflect the economy.
Okay.
That's what it's intended to do. Started in 1896 was when the first actual Dow index was. But one of the things that it's hard to turn on the television set anymore or go to the internet or look on your cell phone or whatever without getting some push notice from some source about what's happening with the economy. And particularly since I think the economy right now reflects improvement in unemployment at a 19-year low, but not an improvement in wages. And that's something I'd like to investigate later. But since people tend to talk about the stock market, they talk about the Dow Jones Average, I take a look at it.
Okay.
So the first big effort I put into it was last May. And what was going on, I remember it was a weekend at the end of May, or close to next to the last week of May. And I can remember looking at these notices. I watch some Sunday programs, and it says worst day in 8 months.
Okay.
Yeah, I love the scare tactics or the gotcha headlines. Dow sheds 370 points.
Breaking news.
Yeah. Oh, yeah. We got to get people's attention. As Trump controversy rattles the market, that comes. Trump worries lower Dow by nearly 373 points. So something that Donald Trump was doing last May, and that's probably about the time that, if you go back and look, that Comey was fired, and we're verging on getting a special prosecutor and all kinds of things like that. So the political climate and the Russian worries are going to rattle the stock market. People are getting jittery as all get out with their money. So anyway, about that time. So the first graph that I sent to you shows the daily close starting on the day after Donald Trump was elected.
Okay, so November 9th, or 2016.
2016, okay. November the 9th. Uh-huh. And here's the two things I look at. So those of you who are watching this video, if you will follow along with me, I look at two things. I look at, is there a period of time where we've got a relatively stable, what I mean by stable is an average value, a bunch of points with an average, and that the points are bouncing up and down, but not going outside of some, what I tend to call a noise band.
Okay.
And I saw that around the start of, or the middle of December. I saw that around the middle of December.
Of what year?
Of 2016.
2016, okay.
there's a place where
Okay,
I have.
so from the time that the election, the day after the election, where you started plotting the data, from 11/9 to December, the stock market has gone up.
It went
There's
up.
no stability really during that time period, other than it's a line pretty much going up.
Yeah.
And then what you're saying is it stabilizes in the second set of data. Once it stabilizes during that time period around, well, what's showing on the graph is December 16th, 2016.
Yeah, and
Okay.
it goes for a little over a month
Okay.
of bouncing around for sure,
Okay.
up and down and up, down and up, down, but no steady increase or steady decrease, and no super wild numbers. I mean, the bouncing around is pretty, could be nerve-wracking for people,
Right.
because if you look at the bottom part of the chart you're looking at, Tripp, you will see that the average change from day to day, the average amount of change from day to day is 58.
50.
So,
Okay. I see the number down there. As far as the second part of the bottom part of the graph with the moving range is 58.2.
That's right, and
Okay.
that's telling us how much the data series is bouncing around.
Okay.
And so when something is bouncing around an average of 58 or a little over each day, you're going to get some small changes.
Okay.
And you're going to get some big changes. And the biggest change was up close to 190, still inside the limit. So here's where investors, traders, people who look at the stock market could get really uncomfortable to be challenged by the idea that we've got a noisy series, but it is a stable series. It's just noisy. Lots and lots of stuff are going on from one day to the next. We're not getting an increase. We're not getting a decrease. We're just getting a lot of noise bouncing around. So I took that as a reference point to say, hey, we do have periods of stability, albeit more volatile than people might want.
Right. I got you. Okay.
So then I looked on further to, every kind of big break point that seemed to me that was sticking out. The stock market went up a little bit in the end of January.
Okay. And stabilized again for
stabilized again, but not for very long.
Couple weeks, maybe.
Couple of weeks. That's right.
Okay.
And then it started to rise.
Okay. Yeah, I see that.
Around Valentine's Day.
Yeah.
And stabilized again in March for about 3 weeks.
Okay.
And then dropped at the end of March, but stabilized pretty much there. Then jumped back up again the beginning of May and stabilized there. That last section, at the beginning of May 1, showing that the day-to-day changes averaged about 27. I mean, that would be a trader's dream. We are not having a lot of volatility here. And plus the person whose 401k is involved or anything else, you'd be quite comfortable. Now, you probably want the stock market to go up during that time when you don't have much volatility, but it does have these stable periods. And then the headlines I just quoted earlier, the hit at the end of May.
End of May.
Okay. A little past the middle of May 17th. Oh my gosh, everything's going to hell in a handbasket. We dropped 370 points. Worst day in blah, blah, blah.
Okay.
In 8 months. So that's the story at this particular junction. And what I wanted to do was use the analysis approach that I have been so successful with in industries, based on Walter Shewhart's approach to looking at data over time and promoted by W. Edwards Deming, looking at how does the background noise of a day-to-day change help us understand when we have really major events that impact a data series. So that's really a large part about why I picked the points of when I reevaluated the limits on these data. I did that at places where there were what I call discontinuities,
Okay.
or things that are dramatically different. If you look at toward the end of that graph, Tripp, you will see just prior to the May 1 time period, you'll see that there's a period of time where the average was about 20,600 and something, and then it just seemed to jump to 20,900 and something.
Right. Okay.
So you've got the difference in those two averages is quite a bit, and here's what I try to look for. I try to look for what is a major event in the economy.
Mm-hmm.
Day to day, we have all kinds of events. We have little bits here and little bits there. And rather than spend time trying to explain every day-to-day change, I'm taking a step back and saying, let's just take some of those day-to-day changes as part of the noise of the economy, and let's look at what are some big jumps.
Okay.
What's driving the big jumps?
All right.
So that's what I've been looking at.
Okay.
And then, what happened in February? Oh, I know what happened in February. There were some discussions on
February of when?
February of 2018.
Okay.
So we're moving forward. I didn't do much with the Dow Jones Industrial Average over the last half of 2017 at the time.
Mm-hmm.
So we're moving into 2018, and I thought, okay, let's take another look.
Okay, so this is that third graph that we see.
Well, actually, I'd like to look at the second graph.
The second graph? Okay.
Quickly, yeah.
Okay.
The second graph is kind of fun in a way because I took the Dow from Trump's inauguration.
Okay.
All the way up to March the 9th, I think it was.
All right.
And I thought, okay, let's just look at his whole administration. Just see what's going on. We had the tax bill at the end of December, and it looks like if I go back, or the end of the year, and the end of the year was a huge increase in the Dow.
The end of 2017.
So excited. And through January.
Okay, yeah.
And through January. So this rascal is rising. I mean, we've got a big mountain going here from under 20,000 up to well over 26,000 for the year. And then somewhere about the end of January,
mm-hmm.
if you look at the bottom chart, you'll see from January 20th, 2017,
mm-hmm.
almost for a year, into January 2018,
mm-hmm.
there's only two of those daily changes that pop outside
the upper control limit.
The upper limit,
For the moving range.
Yeah.
Okay.
But a key piece is, if you remember, back in 2017, if you remember, the average moving range at one point was about 60, 61.
Mm-hmm.
At another point, the average moving range was down as low as 27 for a short period of time, indicating not much volatility from day to day. And now the average moving range shows over this year an average of 96.
Okay.
So, however people felt about things going on, if you had some queasiness, you probably had a good reason to have your queasiness, because the day-to-day changes, the day-to-day volatility in the economy, as reflected by the Dow Jones Industrial Average, is bigger.
Okay.
Bigger swings. On the average, bigger swings.
Okay.
And then all of a sudden, by about the 1st of February, things go ballistic. They go ballistic on the top chart, the daily average, the daily close. They go ballistic. They drop like a sinker and go ballistic. You can just see it. You can see the excitement.
Volatility of 2000.
And then those day-to-day changes go ballistic as well.
Yep.
And that's what leads to the third chart.
So I'm wondering, I mean, there's much to speculate on here, but, I know going up to the end of 2017, we had the Tax Cut and Jobs Act, right?
Uh-huh. Yes.
And then that passes, and then it's almost like, okay, now what?
Yes.
Like it started to build,
Right.
based upon that. Now it's dropped. Now I'm sure there's combination of reasons why, but
Mm-hmm.
but it's dropped. Now I guess the question is, has that leveled off?
Well, let's take a look at it because I looked at the
Okay.
average today, and it's kind of
Okay. So now
we'll
you're
see.
looking at the third chart, correct?
I'm looking at the third chart. Yes,
Okay.
it
So
says
now we're looking at from the beginning of January of
the
this year,
beginning of January. Yeah, we're looking at
2018,
2018. That's right.
up
That's right.
till the 28th of
Yeah.
March. Okay.
Yeah, it was the last one was actually, the 28th of March, it looks like. January is a good month for folks.
Okay. Yep.
The stock market was climbing.
Mm-hmm.
Yeah, going down from under 25,000 to well way up there, close to 26,500 or so.
Mm-hmm.
Unfortunately, during that climb, the day-to-day changes were even bigger. If you look at the average moving range of 131,
Okay. Then historically it had been during
Yeah.
that run from the time of his inauguration.
Mm-hmm.
Okay.
Yeah, a little bit higher than it had been, about 30% higher or something.
Okay.
And so the stock market's going up. It's like gangbusters, gaining momentum and having greater changes each day as it goes up until February 2nd.
Okay.
And February 2nd, kaboom. The change from one day to the next was huge. You've got inside there the first on the moving range chart Tripp. You've got in that February 2nd to March 23rd time frame. You've got a point way outside the limit that's quite red. It's close. It's almost 1,200. It's 1,100 and something,
Okay.
which is a daily change. I mean, that's a big one.
All right.
And as you go through,
It looked like it did that for like 4 days or 5 days or so, and
Someday,
then it
yeah,
started to
early-
level off a little.
early February was a rocky road, and
Okay.
then the Dow leveled off, just to 24,000, close to 24,900,
Okay.
and that's a big drop. That's almost 2,000 drop from its high in January.
Okay.
Not quite 2,000.
Yeah.
but close.
The 24,884 is what
Yeah.
it averaged during that time between February
Yeah.
2nd and March 23rd, 2018.
That's right.
Okay.
And the interesting that was a drop on the average of about 1,000, but it was a drop of much more than that from the high point in January.
Right.
Yeah, and you'll notice that the day-to-day volatility is also higher. The day-to-day changes have
Mm-hmm.
jumped up. What is it? 131 to 278 is doubled.
Okay.
So we're talking about furious changes day to day to day to day to day. People are all in a dither in a sense, and all of these changes. This is kind of a fascinating piece about this technique of looking at data. All of these changes are driven by how people respond over a short term. And so if you, for the stock market, it's the investors, it's the professionals, it's the people who are trying to protect what their portfolios are. It's just all kinds of things. And it would be interesting to have a wider conversation with people who deal with how the investment's done, thinking about some of the electronic trades, etc.
Yep.
It'd be interesting to see how much those help increase the noise in this time. On March, at the end of March, the stock market dropped another 1,000 points on the average. to 23,880. And the last 5 data points show that. And the day-to-day change increased even more. So,
Okay. 362. All right.
yeah. So we're getting a lot of volatility. And I think looking at the stock market, the Dow Jones Industrial Average this way, gives a picture to the nervousness of people in our economy.
Okay.
Even when the stock market is so much higher than it was at the beginning of 2017, it's still gone up, from 19,000 area up to 23,000. So that's not an irrelevant rise. At the same time, the increasing day-to-day jumps are a bit nerve-wracking, I suspect, for a lot of people in the business.
So if we just kind of step back for a second, we look at this third graph, we see there's volatility. If we look at the bottom chart, we look at the moving range. It was 131 moving range, the average moving range, and then it jumped to 278, which that's almost double. Well, it is. It's more than double. And now we've had it another third, 33%. It's grown. So the volatility in the market's growing from at least this year.
Yes.
Okay.
It is definitely jumped. And it may be, one of the things that I'm convinced of in any data series is there's information from one day to the next, the short term. But there's also information looking over a much longer period of time and seeing when is there a major impact. Now, in the 2008-9 time frame, late 2008, all through 2009, we need to see a chart like this to know we were getting kicked like crazy.
Right, you can feel it.
But a chart like this can help quantify what that is about, and then we can measure the gains, the improvements from it. So, and we can also start talking about what does it mean in our economy to have this level of a day-to-day change. What are the things that constitute the basic noise of a series like this, and what are the things that constitute some major changes? So that's what I've tried to highlight as I've taken different periods of time. And I don't take different periods of time based on any particular event. I take the different periods of time based on what the data are doing. And then back off and say, okay, can we match this kind of behavior with an event that would explain it?
Okay. All right. So what is our final conclusion with regards to these? We know that the Dow Jones Industrial Average, since really the election, has gone up. It peaked, and then it started back down, and now we see increasing volatility in the day-to-day stocks. Is there anything else?
I don't know. Well, the trade and tariff piece, the big jumps, to some extent, I think the things like the trade and tariffs decisions are going to impact both the volatility and the average level in a major way.
Yeah, I mean that's an interesting. That's a whole interesting discussion, because the fact that they're standing up to China for stealing intellectual property and a number of other things that they're out there doing, their tariffs are actually higher than what we've imposed on them by individual products. That may that course of action and calling them out may be a short, midterm, long-term negative effect to the Dow Jones Industrial Average, but it might wind up being something that is good for employment and other things. I don't know. I mean, or saving industries anyway. That's the interesting thing about systems is, sometimes one goes south, right? And then another one gets better. It just depends on, and the trade-off may be, keeping jobs and security in the U.S. and what are you willing to trade off for that? That becomes an interesting question. Yeah. Yeah, go ahead.
Yeah, here going forward, here's something that I would really find exciting to be a part of. Looking at a lot of economic measures, the Dow in this particular case, and what it's saying, and having a framework in which to differentiate the discussions about what's happening day to day versus these big jumps, and bring in folks whose level of expertise and knowledge about the economy and various parts of it. From a statistical standpoint, I love looking at data and asking it what are the messages in here, and basically I can come out with messages that say we got a lot of day-to-day movement in some time periods and not as much in others. We do have some stability in some of these time periods, but what are the things that mark the beginning and ends of those time periods that would help us understand the big events and how the big events impact our economy?
Well, we can see some of those. One way of doing that, looking back, would be to look at the events of. Well, we could see it in the data from 2000 and let's say 8, right?
Yes,
the drop, so we can feel that. Probably the Great Depression. You probably would be able to see that, and a series of other things. The internet bust and some of those are pretty obvious. I think I always wonder. Everybody comes up with a different conclusion when they look at these data, but I think that my takeaway from looking at this is, we've got increasing volatility from day to day.
Right, we do,
and we've seen there's some drops since the beginning of the year. Starting in February 2nd, where it kind of leveled off for a period of time, for it looks like 7 weeks or so, and then it's dropped again.
Yes. So here's another piece, that I think I really would like to bring into the discussion, and that is that when we have an analysis tool like this particular one, and can show periods of relative stability with an average and an average daily change that we can look at and make some sense of, and then look at the discontinuities when there's big jumps from one of these periods of times to the other. What we have going forward now is a record, a record not just of the Dow itself, but a record of when it had sustained daily changes that were small and when it had sustained daily changes that were large. And we can begin to look not just at the times when something changes from one way to another, but also ask ourselves, during this period of time when we had an average daily change of about 60, what was going on in the economy during that time versus what's going on in the economy during the time we have an average change of 280?
Yeah.
What can we learn about our economy that can help us figure out how to run the various parts of it better by asking those questions and by looking at these pieces? We've got things quantified now. the noise is being quantified in a way that it wasn't before.
Yeah, no, it's good. It's curious to see how this plays out as time goes by.
Yeah, me too.
So, okay. All right.
Stay tuned. Today's, just to follow up at the end of this one, the stock market dropped 600 and some today.
And today is April 2nd, 2008.
Today is April 2nd. That's right. At 324, the Dow is down about 600 points.
Okay. But that's still within the limit at the moment.
Wait a minute. Hang on. No, it was 6. Was it 6? No, actually, it's not down quite that much, is it? Oh, maybe it is. I'm watching it go bouncing around. So that 602 may have been its biggest one.
Okay.
Anyway.
Okay.
We'll see what happens.
Okay. So what level is it at right now?
Right now, if I refresh real quick,
23,485.
Ooh, it says it's at 23,485.
Right. So that's still within your March 26th through the 28th limit. So the lower control limit there shows us 22,917.
Right. Yes, it is.
Okay.
23. But it's getting on the low side, Tripp.
Yeah, I hear you.
It's headed down there. And the thing is, with the kind of volatility we've got, we shouldn't be surprised that we get this big a drop.
Okay. Yeah. So because it's 362 all the way up to 1,183.
Right.
Okay.
I know.
All right. Cool. All right. Well, this was interesting.
Yeah.
All right.
Okay. Thank you.
Thank you.
Wow.